However, it may not pertain to you because your situation might be very different from what I am going to be presenting today. So in order for you to take any kind of tax position on your tax return, you must have a written statement from me, basically letting you know that, yes, based on your personal circumstance, you may use this tax strategy specifically designed for you with your own circumstance in mind. Okay?
All right. So what are the credits? So first, if you have kids who are under 5 years old, 5 and under, okay, each of them will get or will qualify to get $3,600. So let's say if you have 2 kids under the age of 5, let's say one is 0 and the other one is 3, then you get 3,600 multiplied by 2, so that will be 7,200 in credit. That's a lot of money the government is giving you. Okay, now for children, for kids who are between the ages of 6 and 17, each of them will get $3,000. $3,000. So let's say if you have 17 years old at the end of 2021 and an 8-year-old at the end of 2021, you get $6,000. Okay. ODC stands for other dependent credits. Okay, so it's not your child. It could be an adult, for example, who qualifies as your dependent, and in that case, you can take an ODC, other dependent credit, which is $500 per person, per dependent. Okay. Now, what's so special about 2021, tax year 2021, is that the CTC, the child tax credit, is a fully refundable credit. Unlike the years before, in 2018 through 2020. So what's the difference between refundable credit versus a non-refundable credit? Okay, so before, let's say if your tax liabilities was 0 and you happen to have, say, $2,000 of child tax credit, okay, but then you owe the government $0 in taxes, the government was not going to cut a check for $2,000 to you. It's not refundable. Does that make sense? But now in 2021, okay, if your tax liability is 0 and you have 2 kids, the government will cut you a check for, in this case, let's say if you have 2 kids, okay, one is 6 and one is 15, the government is going to write you a check for $6,000 and send it to you as a gift. Isn't that wonderful? Okay, that's why it's called a fully refundable credit. So even if you owe the government 0 taxes, you will get this money in your pocket. All right, so if you want to know more about this, you can go to this website on YouTube. The IRS actually has a YouTube channel. Everybody, do you know that? I hope you know that, right? I'm probably the only tax preparer out there who's telling their clients and all the viewers that the IRS has a YouTube channel. Yes, they do make YouTube videos. Everybody, you can go and you can Google it if you want to, but it's basically, it's called YouTube. Let's see what it's called. It's called IRS videos. Okay, so you go on the internet, type in IRS videos. It will bring you directly to this YouTube channel that has tons and tons of videos done by the IRS. They are done on various topics, okay? They may even have a topic on child tax credit as well. So my channel is not the only channel where you can learn about child tax credit and other tax topics, right? You can also go to the IRS's channel as well. And you will get a lot of resources from the IRS. So kudos to the IRS. Okay, so I'm not sure why my slide is not looking very nice. My apologies. All right, so the next credit on the list is the Child Independent Care Credit. Remember, Child Independent Care Credit is a second credit. It's not the same as the first credit that I just talked about, the CTC, the Child Tax Credit, okay? So if you pay someone to care for your kid while you're going to look for work and work a job, you can claim a credit for the expenses that you pay to that person. Make sense to you? That's why it's called a child care tax credit. Now, your child has to be under 13 years old. And if it's not your child, let's say it's your mom or dad, okay, who lives with you, who's physically and mentally not able to care for himself or herself. So then you can also take this credit. That's why it's called a dependent care credit, okay? Now, very similar to the CTC, this credit is also a refundable credit, unlike the prior years. The credit itself is $8,000 per child, okay, up to $8,000 per child maximum. And if you have multiple children, you can claim up to $16,000. That's 16 with the 3 zeros behind it, right? $16,000. Y'all, this is a lot of money, okay? So I'm very happy for families who had to pay for childcare in order for them to go to work in 2021, okay? Because I've never, in 2020, we didn't have that much of a credit for child independent care credit, okay? Now, if your AGI goes over, okay, or is at $125,000, then this credit will be phased out. Phased out means it's going to be reduced. So instead of getting $8,000, okay, because now you have too much income, or the government determines that you make too much income, therefore, your credit is now no longer 8,000, it's going to be less. Make sense? And the more income you make, the less credit you're gonna get. Does it make sense to you? So as far as tax planning goes, if you do your calculations before year end, hopefully you did that with your tax CPA, right? And you went, oh my goodness, my HEI is going to be over 125,000. I need to reduce it so that I could take 100% of my child care tax credit. Okay, and then you start doing some calculations to figure out how you could reduce that income, right? And by the time you prepare your tax return in 2022, you will get your entire $8,000 credit, dependent care credit, okay? But if you didn't do the tax planning, let's say you didn't do any tax planning at all in 2021, by the time you file your tax return in 2022, your income, your HEI is $125,500. So you make $500 more, right? And now you're like, right? You cannot take the entire $8,000 of child care credit on the tax return. You see the difference between planning for your tax versus not planning for your tax. Makes sense, right? Okay. And so what does the phase out look like? The credit is decreased by 1% for each $2,000 above $125,000. Okay. And then when your HEI hits $183,000, it's at 20%. That's a lot of reduction in the credit. So basically, your credit is going to be 1% less for each $2,000 above the $125,000 of HEI. Okay. And then if your HEI equals to or greater than 438,000, there is a zero missing there. My apologies. The credit rate is completely phased out. So you can no longer get any kind of credits. So I would imagine that a typical couple in the Silicon Valley, okay, California, that I'm talking about, would make, you know, like middle managers or so, would make an HEI that's more than $438,000. You know, so in that case, none of the childcare expense would qualify to get this kind of credit at all, right? So you totally like, yeah, it's out the window. It's only for a couple, for families whose income is below that number, right? $438,000. So do you remember when I showed you an example, you know, with all the numbers of a couple with certain types of income, W-2 incomes previously? Well, let's go ahead and revisit that, okay? And see how the new tax laws in 2021 impact this couple. So in this case, the total gross income right here is still at $140,000. The standard deduction is $25,900. The HEI is $214,100. Okay. And then in figuring out their tax liability, here is their tax liabilities. Okay. They owe $39,426. And then fair withholding number is $27,000. But because of these two huge CTC and CCC, right, child care credit, they have 2 kids, and then they also have 2 kids aged 0 and 3. So they have a maximum child tax credit of $7,200. And then they also got a maximum credit, child care credit for one of them at $8,000. So now this is a negative number. What does a negative number tell you? Well, it tells you that this taxpayer is getting a refund from the IRS of $2,774. Okay. So I'm going to talk about the stimulus payments next. But those of you who don't remember, in 2020, so not last year, 2021, but the year before, 2020, right? In April of 2020, the government sent out $1,200 to people who were eligible. And then it also sent out another $600 in December of 2020, okay? And then for families that had a qualifying child, the government also sent out $500 to that family. Okay. And then back in December of 2021 and early January of 2021, December 2020 and early January 2021, the government also sent out $600 and then another $600 for each qualifying child. Okay. And then it didn't stop here. There was a third one. In case you don't remember, do you remember the third stimulus that went out? Anybody? Okay. Yes, there was a third payment that went out, and that was in March of 2021. Okay. And that was $1,400. And for each dependent, they will also get $1,400. Okay. So y'all, it's a great time to have a child, okay, in 2020 and 2021, okay? If you had a qualifying child in 2020, you would get $500 for that child, and then another $600 again in early 2021, and then in March of 2021, that child also got $1,400, okay? Now on top of the child tax credit. You hearing me? All of this is on top of the child tax credit that I talked about earlier. Okay, so basically, so let's revisit this. Let's just say if you have a child in 2021, okay, you should have gotten $2,000 per child in 2021 via stimulus payment from the government. This has nothing to do with the child tax credit, okay? This is just the stimulus payment. I call it stimulus payment, okay? The official word for it is economic recovery rebate, okay? So remember that word, economic recovery rebate. So when you receive my organizer, and Wes asks you, do you receive an economic recovery rebate? You remember, Susanna talked about this. It's a stimulus payment. Oh yes, I did receive that via direct deposit. Or no, I never received that. I better let Susanna know, or write down in the organizer, I never received it. But again, you gotta be very sure that you never received it, because there have been situations where the taxpayers received it and they forgot, or they lost it, you know, in the mail or whatever, who knows, right? Something happened. The government sent it, they didn't receive it. And then when they filled out an organizer, they indicated that they didn't receive it. And so we claimed the same amount of money on the tax return. And that causes the IRS to issue a notice to the taxpayer, which then freaks out the taxpayer, right? And so we have to like spend extra time to like figure out what's going on. Oh, the check never came, even though the government sent to the taxpayer, you know? So it's a headache, I know. It's not as simple. All right, so now how do you know that you as a family qualify for the third stimulus payment? Okay, let me do my one sip of water and then I'll talk about that. All right. So now, if you're a single person, your income has to be between $75,000 and $80,000 a year. Okay. Now, when I'm talking about this income, I'm going to be talking about for each filing status. Okay. So first is a single, and then the head of household. This is what we're looking at, from $112,500 to $120,000 for head of household. And then if you're a married person filing joint with your spouse, then both of you need to make between $150,000 and $160,000 in order for you to receive this third stimulus payment. Okay, the one that I just talked about right here. Okay. So what the government did back in March of 2021 was that it looked at your 2019 and 2020 tax return to determine if your income fell between these numbers or not. If that was the case, then they would issue you a check, a stimulus check for this much. Okay. And then of course, in 2022, when you filed your taxes, if your income happened to be more than that for 2020, then you get to keep the money, right? Good for you. But if you happen to make less than this number, right, and you basically qualify, then you can claim that third stimulus payment when you file your 2021 tax return in 2022. Okay. All right. So I talked about first the earned income credit, not earned income credit, the child tax credit, the child and dependent care tax credit. Any questions? Anybody? It's very self-explanatory, right? All right. So our next credit I'm going to be talking about is the earned income tax credit, right? For short, EITC. All right. So this credit has been around, oh my goodness, for as long as I remember. Okay. So it's been around that long. And the purpose of this credit is to help low and moderate income workers and families to get a tax break. Okay. Now, how low is low income? You can see here on the bottom of this slide. Okay. These are the type of income we're looking at. So if your income fall between these numbers, and if your filing status is this, or if you have no child, or if you have one child, 2 children, or 3 or more children, this is the kind of credit that you're looking at. Okay. So again, very similar to the other 2 credits, which are what? Everybody? The child tax credit and the dependent and child care credit. It's refundable. That means even if you don't owe the government any tax at all, they will send you a check. There are some limitations though. Your investment income cannot be more than $10,000. And the rationale behind this, of course, is that the government doesn't want people who live on passive income to be getting an earned income credit. So you actually have to have like go to work and earn income, right? Have earned income, you actually go to work and not just sustain your lifestyle by just relying on your investment income. You know, like a lot of people who have a lot of investments in stock, in bond, and it's not fair, right? It's not fair for them to claim this earned income credit when a family has to go out there and work hard and make money and be eligible for the same credit, right? And so there's a limitation. So if your investment income credit, the investment income is more than $10,000, then you cannot take this credit. But if your investment income is $10,000 or less, then if your income falls into these numbers, then you may be able to take an earned income credit. Now, if you are a single person, or let's say in this case, if you are married filing jointly kind of taxpayer, okay, and your AGI is say 48,000, $108 and you have one child. Okay. So you're looking at between $9 of credit to $36.18 or $3,618, depending on where your income is. The government actually has a table, okay, and you can kind of look it up and see where, here's my HEI. Oh, here's the credit, so it's very simple, okay? Now, the qualifying child has to be under 18 years old. And if that child is between the ages of 19 and 24, okay, but that child is a student, a college student, then that child would be considered a qualifying child for earned income tax credit purposes. Make sense? Okay. So I want to show you an example here. I don't know if I have an example here. And if the child is permanently and totally disabled at any time during 2021, and has to be younger than the taxpayer in order for that child to be considered an eligible or qualifying child for earned income tax credit purposes. Okay, so a child has to be younger than the taxpayer. Okay, and you go like, hey, Susanna, like, what situation would a child be older than the taxpayer and therefore making him or her not a qualifying child for earned income tax credit, right? Well, there's a situation where, let's say, a husband and wife, a husband is 50 years old and the wife is 18 years old. Okay, it's just like this example, okay? And the husband has a child, right? His child, and that child is say 23 years old, for example, okay? So that's a situation where the child is not younger than the taxpayer. So let's say if the husband doesn't work and the wife is the only one working, okay? So the 18-year-old, I know, it's crazy, right? It's a very wild example. The husband, the 50-year-old man doesn't work, married a younger girl who's 18, okay, with a stepchild of 23 years old. So the husband doesn't have income. The wife has income. In this case, can this couple claim the child? Here, in this situation, one child, married, filing joint, can they claim this child who is 23 years old? And the answer is no. Why? Because the child is not younger than the wife, who is 18. Does it make sense to you? Okay, so the laws are very particular, so you got to pay attention, like all the little things like that. Okay. So I know. Okay, no more laughing. Okay. All right, now the child, if that child is in school, it doesn't have to be a college in order for that child to be considered a qualifying child for earned income tax credit purposes. The school could include trade or technical school or on-the-job training school, okay? Unfortunately, internet schools offering only online courses, like, I cannot remember, there's an online school. Oh, that escapes me. That has a lot of courses on the internet. Well, that school, if your kid only attends that school, then it's it's not considered a school, okay? It's got to be a trade school or a technical school, not on the job training courses, right? So if your child is on a job to train to become, I don't know, to become something, okay? And in addition to like being trained on the job to do certain things, they don't actually go to school. Then that particular education on the job training courses would not be considered a school for tax purposes. Does it make sense to you? Okay. So like, for example, if your child goes to a school to learn how to become an electrician, okay? So that's on the job training, right? But in addition to on the job training, the school also wants your child to go to school and actually be in the classroom and learn the stuff, you know, in the classroom format, right? So it's not like purely on the job training, right? So that would qualify for the earned income tax credit purposes. Does that make sense to you? Okay, so the laws are very particular about this little area here, okay? And I also noticed here the 5 months rule. So as long as a child could prove that he or she attends school for 5 months, 5 months out of the 12-month year, okay? And then that child will automatically be a qualifying child for earned income tax credit purposes, okay? That's why I had to put this down, the 5-month rule, to call to your attention, because some people think that, oh my goodness, my child doesn't go to school for the entire year. Maybe she only goes to school from March until May and took off for the summer, and then she attended school for September and October and then dropped out because of COVID or whatever, right? And therefore she's not eligible. No, is, you know, as long as a child is in school for at least 5 months, right? And they don't have to be consecutive too. Then that child would be considered a qualifying child for this particular EITC purposes, okay? Oh my goodness, I spent so much time, 20 minutes talking about the earned income tax credit. All right. So I talked about 3 credits already in step 5 of the 6-step process. Now, number 1 is the child tax credit. Number 2 is the child and dependent care credit. And then number 3 is the earned income tax credit. And then number 4, I'm going to be talking about a credit that I don't think a lot of Americans actually take on the tax return, okay? And that is adoption tax credit. So basically, if you adopt somebody, in this case, in this example, a child during the year, you can take up to $14,440 per child. Okay. Unlike the other 3 credits that I just talked about, this one does not have this refundable classification attached to it. So what that means is if you owe the government 0 tax liability, then the government is not going to cut you a check for $14,440 at all. That's what it means, not a refundable credit. However, if you happen to adopt a child in 2021 and you owe the government 0 tax liability, okay, and you get a credit, you compute the credit on your tax return. You're not getting any cash money from the government. Then you can carry over the credit to next year, 2022, 2023, 2024. 4, right? 5 years in a row. So that's why I'm saying it can be carried forward any unused amount to 5 years. The child has to be either under 18 years old or be physically or mentally unable to take care of himself or herself. So you cannot adopt anybody who's above 18 years old and take this credit on your tax return. Number 4 here, as I said earlier, the reason why there are some credits that needs Maggie in order to be computed, and this is one of them, the adoption tax credit. Okay, so the credit is being limited to certain kinds of Maggie. Okay, and I even wrote here, note the difference between Maggie and Aggie, right? Okay, so if your Maggie, okay, if your Maggie is below 216,660, you get the full credit of 14,440. Very simple, right? But if your Maggie is between this number, 216,660 to 256,660, then you get a partial credit. And if your Maggie is above 256,660, then there's no credit for you. Okay, so as far as tax planning goes, this is why it's important to do tax planning. You, in a year, let's say if you adopt a child, okay, you want to be in a situation where you keep your Maggie below this number. You don't want to be selling a lot of stocks, right, to generate more income. You don't want to get into a situation where your income is above this number, 256, because by doing so, you get no credit. Does it make sense to you? So you got to do your tax planning in a way that would help you maximize certain credits in a certain year, if that makes sense to you, right? Like if you don't know this, then you would just doing all the things that you want to do without regards to the tax ramifications of your action or your decision. So where am I? Adoption tax credit. Yeah, I was talking about how I have not done a lot of tax returns that have adoption tax credit. Okay. But the credit is there for you to take, so alrighty. So the next credit, let's see, what time are we at now? Okay, we're almost done. All right, the next credit, so we talked about the child tax credit, we talked about the child independent care credit, we talked about the earned income tax credit, we talked about the adoption tax credit. So this is the 5th one, the credit for the elderly and the disabled. Okay, so believe it or not, when a taxpayer is considered an elderly or a disabled, he or she can take a certain credit on his or her return. This tax credit is very similar to the previous credit that we just talked about, which was the adoption tax credit, is that it's non-refundable. That means that when you don't owe the government any taxes, they're not going to cut you a check like it would if it was your child tax credit or your child independent care credit. Okay. Generally, this credit, the way it's being computed is a little bit complicated, a little bit convoluted. Okay. It has an AGI limitation, which I'm not going to get into. I don't think I have the time to get into that. But basically, the long and short of it is the taxpayer has to be 65 years old or older by the end of the tax year. Okay. Or if the taxpayer is younger than 65 years old, he or she must be retired or be permanently and totally disabled. Okay. And has taxable disability income and has not reached the mandatory retirement age. That's that. And it's important for them to be a legal resident alien and also a US citizen. And then of course there are some exceptions to those who are married to a US citizen or a resident alien, if that person is a non-resident alien. Okay. I know it's a lot to handle. Okay, so let's revisit, right? Let's review the 6-step process. Okay. Number 1, you determine your filing status. And there are 5 filing statuses: single, married filing joint, married filing separate, head of household, qualifying, widower. And then once your filing status is determined, then you're gonna compute your AGI in step number 2. Now, when your AGI is determined, then you can deduct from your AGI either a standard deduction or an itemized deductions to arrive to your taxable income amount. Okay. And then step number 4, you use your tax table issued by the IRS annually to figure out the income tax liability on the number 3 amount above here. And then number 5 is when you figure out any kind of credits, right? And we talked about the credits today. And we touched upon the 5 credits that are typically seen on most of taxpayers' tax return. Okay. And then step number 6 is when you determine whether or not you owe the IRS or they owe you any money. Simple, right? Okay. So the question is, what step is the MAGI? Okay. So the MAGI determination will be done right around here, step number 5. Okay. Sometimes it could be done here in step number 3 as well, right here. Okay, because you have to determine certain kind of deductions or certain kind of add backs from your AGI to figure out whether or not you can take that deduction. Okay, so, or sometimes when you're at this stage right here, right, stage number 5, where you have to figure out credit, like for example, the lifetime learning credits, you go like, oops, I figured, oh, I might be eligible to take this credit. Oops, I didn't figure out what my MAGI is. So now you have to go back to step number 2, right? Now that you have your AGI, and then you have to add back certain income to derive to your MAGI, your MAGI, and then from there you can figure out your credit in step 5. Does that make sense to you? Okay. All right. So, all right, as a summary, I want to kind of give you like an overall big picture again, as kind of like a review, if you will, in case if you don't remember what we talked about several weeks ago about different tax brackets and like the overall tax brackets. Okay, so you've seen this before, right? The blue line is the top ordinary income tax rate. And then the red line is the capital gains tax rate history since 1916 until 2010. Okay, so as you can see, the top ordinary income tax rate has always been, or most of the time, higher than that for capital gains tax rate. Okay, so if you're a top income earner, as far as ordinary income tax goes, you may want to think about how you shift your income, right? Take a look at your portfolio and then have a plan of action, if you will, okay? And this is also important for legacy planning as well, okay? Next picture is another big picture. Big picture about marginal tax rates in the US for the last century or so, since 1910 all the way to 2018. So as you can see, the blue line is the top marginal tax rate. And then the green line is the lowest marginal tax rate throughout the years, okay? The reason why I'd like to share this with you again, I keep repeating this, very often, just to let you know, to forget about the notion that your income tax rate is gonna stay constant for the rest of your life, okay? When an advisor or anybody that talks about how your income is going to be lower when you retire, you got to show them this picture, okay? What I'm trying to drive at is that nobody has a crystal ball. What tax rates are gonna be 30 years from now, okay? So for example, let's say if you were born in 2010, okay? And then by the time you're in your 20s, right? Like in the 30s, let's say you are in this tax bracket, right? When you're in your 20 actually. Yeah, when you're 20 years old in 30, 20, right? And then when you retire, let's say 60 years later, right? And let's say you were born in 2010. By the time you're retired, right? That would be in 75, right? Right here, 75, right? When you're 65 years old. Well, guess what? You see how the tax rate in the year 1975 was way, way higher than that back in 2030? You see what I'm talking about? So if this tax advisor or financial advisor advising this person, this individual, that, hey, look, you gotta do certain strategy because your tax rate when you retire will be lower than what it is now, okay? Do you think that might be the case for this particular client? You know what I'm talking about, right? Obviously, it was not the case, right? It was down here back then in 2030 for this particular person. And then it was way, way, way up here in 1975. Granted, for the next 10 years or so, it went all the way down, but then it went back up again, right? So if this person, let's say if this person retired when he was 65 years old, right? The next 10 years, he pretty much didn't pay any taxes, but then guess what? When he's 80 years old, right? Let me see. 70 years old, 1980 or 88, right? 88, right here, 78 years old. Imagine when you're 78 years old, okay, and you were doing your retirement planning based on the assumption that the tax rate was gonna stay constant, right? Which is this low. And when you are 78 years old, it went all the way up this high. And remember, this is the lowest marginal tax rate. Okay. I'm not even talking about people who are in, at this tax rate. You see what I'm saying? This will really mess up your retirement plan, isn't it? You know what I'm talking about, right? So never think for 1 second that your tax rate in your retirement years are going to be the same as it is today. I would challenge any advisors out there who keep saying that to their audience and their clients, really, because I would just take this picture and show them, hey, look, nobody has a crystal ball to affirmatively say that the tax rates are going to be the same 20 years from now, 30 years from now. So as far as planning goes, what can you do? What can you do to address this? I call it a wild card, okay? Because when you're in your retirement, the tax rate is really a wild card. You have no control over it whatsoever, right? You know what I'm talking about? So if you set everything in motion, right? And boom, the tax rate just go up like that, like the way it went like this, right? For those with a higher income bracket, right? It goes from here, I say maybe 22%, right? And then now it's at almost 40% and maybe more. You see what I'm talking about? So on hindsight, we always know the government is going to do something with the tax rate to generate more revenue, to finance all kinds of programs, right? So in order for you to put together a sound financial and retirement plan, you have to take this into consideration, ladies and gentlemen, okay? And really sit down with your financial advisor, show them this picture, right? Or if you're my client, make an appointment and sit down with me, and we can do some tax planning to address this wild card. What can we do to, in case if the tax rates go up in the future, you're not gonna be pretty much surprised, right? You have to go back to work because your income now is not sufficient to pay for all your expenses, So, all right. I'm not going to beat the horse to death, okay? Because the horse is already dead, okay? So to conclude my presentation about the U.S. individual tax bracket topic, I want to end on another joke, okay? So here's the IRS, the guy with a black shirt, black jacket here. And here are the taxpayers, husband and wife. And the husband says, claim false dependents? Who would do such a thing? And look at the wife, who pretty much is trying to pretend she's holding a little baby who happens to be a cat, I think. And then there's a little puppy on the couch, on the sofa, pretending to be a kid. Anyways, it's hilarious. Here's my contact information. If you need to send me an email, call me, look me up on LinkedIn. There are multiple ways to contact me. The best way to contact me is by texting me. Okay, now during the busy season, the best way is always an email. But outside of the busy season, outside of April 15th deadline, the best way to contact me is by texting. And here's my phone number, okay? Until next time, you enjoy the rest of the week ahead of you, and hopefully we're gonna reconvene again on a different topic of your choice, of course. Thank you, everybody. Goodbye.